Hello everyone and welcome to Crafting Winning Strategies with Candlestick Patterns. My name is Ali Mortazev, your guide and head of training and education at Errante Broker. Today, we will delve into the practical applications of candlestick patterns in trading. Originating from 18th century Japan, these patterns have become a staple for technical analysts, offering insights into market sentiments and potential price movements. As we navigate through the intricacies of candlestick patterns, you will learn to recognize key formations and understand what they could mean for your trading strategies, whether it's the bullish reversal indicated by a hammer or the bearish warning of a shooting star. Each patterns tell a story. However, remember, while these patterns can provide valuable signals, they are most effective when combined with other technical indicators and fundamental analysis. Today's session aims to equip you with the knowledge to identify these patterns and more importantly, to understand the context in which they develop. So let's take a moment to introduce Errante. The firm stands on the pillars of integrity, innovation, and client-centric services, ensuring that every interaction and transaction is handled with the utmost professionalism. Errante's dedication to providing educational resources exemplifies our belief in nurturing informed traders. Our commitment to enhancing your trading journey is reflected in the continuous development of user-friendly interfaces and cutting-edge technologies, all designed to provide you with a seamless and efficient trading environment. Before we proceed, let's acknowledge the importance of due diligence in forex trading. This slide signifies a general disclaimer and necessary steps to remind us all that while we share knowledge and strategies in the realm of forex trading, each decision made by traders should be based on their own research and understanding of the market risks. So please don't take any of our examples or strategies as a advice to invest, but it's solely for educational purposes, because better that all the forex products like CFDs are very risky products. So it's very important to consider your condition, your level of financial knowledge, your risk appetite, and also your capital before entering into any trade. Okay, here you can find out what we are going to discuss today as we chart our course through today's webinar. Our agenda is designed to achieve specific outcomes that will enhance your trading insight. Firstly, we will review the goals of using candlestick patterns. Understanding these foundational elements will set the stage for recognizing market sentiment and market volatility to identify trends and reversals in the market. Secondly, we delve into common three candlestick reversal patterns. We will take a closer look at the morning star and evening star formations, as well as the nuanced 3 insides up and 3 inside down patterns. And these are vital tools in the arsenal of any technical trader. Next, we will align essential trading principles with candlestick patterns. This segment is crucial for grasping the most important rules that govern the application of candlestick analysis in live trading scenarios. You might see there are many different strategies developed based on the candlestick reversal patterns, but I tried to gather the most important rules and give you a hint to develop your own strategy. So we will also cover bullish and bearish trading strategies, and you will gain expertise in identifying optimal entry points, setting appropriate stop losses, and determining take profit levels using candlestick reversal patterns. Lastly, we will have an interactive Q&A session. This is your opportunity to participate actively, ask your questions. Don't hesitate to ask any as soon as they arise, and ensure that you can apply the learned principles to various trading scenarios. And our goal is to deepen your understanding and prepare you to integrate these techniques into your trading strategy. So by the end of this webinar, you will be equipped not only with theoretical knowledge, but also with practical insights that you can apply to your trading activities. So as we embark on today's webinar, let's first revisit some key concepts from our previous session on volatility and sentiment in the Forex market. We discussed that volatility in Forex represents the degree of variation of a trading price series over time as a critical aspect that can indicate market stability or turbulence. We looked at indicators like the average true range and Bollinger Bands, which help traders gauge market volatility and manage risk effectively. We also examined market sentiment, another important concept in Forex trading. The overall attitude of investors towards a particular currency pair. This sentiment can be deciphered through various indicators, including sentiment analysis tools, economic news, and Forex calendars, all of which provide insights into the market's mood and potential direction. Lastly, we explored how candlestick patterns serve as invaluable tools in reflecting short-term volatility and sentiment shifts. Patterns such as Marabuzu, Doji, those single and dual candlestick patterns that we discussed in our previous webinar, they can highlight market dynamics, giving traders a visual representation of market movements and trader behavior. As we proceed today, we will build on these foundational insights to deepen our understanding of the Forex market and refine our trading strategies further. In our last webinar, also, we focused on the critical role of candlestick reversal patterns in technical analysis, which are key indicators of potential shifts in market trends and sentiment. We covered how these patterns can signal an impending change in the direction of the market. We examined single candle reversal patterns, if you remember, such as the hammer, shooting star, and doji. Each of these is characterized by a distinct shape, often signaling an immediate shift in market sentiment or indecision between buyers and sellers. The clarity of these patterns makes them powerful tools for traders to anticipate and react to market movements swiftly. We also delve into dual candle reversal patterns, discussing the hanging man, shooting star, and also some patterns like engulfing, bearish and bullish engulfing, Harami patterns. Those signaling a possible bearish reversal or bullish reversal in the market. Conversely, the shooting star, for example, resembling an inverted hammer, is observed during a downtrend and can indicate a bullish reversal. And today, we will build upon that foundation by exploring the nuanced world of triple candle reversal patterns. And these include the morning star, evening star, as I mentioned before, and the three black we call them, let's say, not the three black crows. I didn't bring them here, but also some patterns like three inside up or three inside down patterns, which are more reliable when it comes to trading Forex. Understanding these patterns is crucial for developing a nuanced approach to market analysis. So let's just jump into on our first pattern, morning star candlestick pattern. let's continue our exploration of the morning star candlestick pattern, a critical and insightful tool in forex trading. This pattern often found at the ends of a downtrend, so it is an ideal of potential reversal from bearish to bullish market sentiment. As you see, it, it consists of 3 candles. The first candle, a long bearish candle colored in red, represents a period of significant selling pressure in the market, and this candle reflects the continuation of the prevailing downtrend, suggesting that bears are in control. So as we move to the second candle, notice it's a small body here, which can be either bullish or bearish, doesn't matter. The pixel here is a neutral or gray color. That would be much better. This candle gaps down, as you can see here, from the first candle and is indicative of the market's indecision. At this point, the bears start to lose their grip and uncertainty begins to set in. The high point of this pattern is the third candle, a long bullish candle colored in blue here. And this candle closes above the midpoint of the first candle, signifying a strong reversal in market sentiment. And here, the bulls have taken charge, signaling a potential shift into a market trend. While the morning star pattern is a powerful tool, as crucial to seek confirmation with additional indicators for higher accuracy, this pattern alone does not guarantee a bullish reversal, but when combined with other technical analysis tools like moving averages or Bollinger Bands, or even pivot points or Fibonacci retracements, it can provide a more robust signal for a potential bullish entry. So as you see here, this is the way that we can usually develop a trading strategy based on this pattern. Traders often wait for additional confirmation, as I said before entering a long position. The first confirmation you can get is to wait for the third candle to get closed above the midpoint of the first candle in the pattern, and then you can just enter a long position considering your stop loss order typically placed below the lowest point of the star candle to manage your risk, and then you can go as high as 1-to-1 risk to ratio, risk to reward ratio, or let's say 2-to-1 risk to reward ratio. Depends on the market condition that we will discuss at the end of this webinar. The next one is 3 inside of candlestick pattern. Another important bullish reversal pattern is this. It acts as an inspiration for traders, signaling a potential shift in market dynamics. We begin with the first candle. You see we have another downward leg or downward swing or downward trend here. And we begin with the first candle, a large bearish candle painted in red like this. And this candle stands tall, representing a period where sellers have the upper hand, driving the market downwards. As we transition to the second candle, we observe a small bodies bullish candle. It can be in any, it can't be in the opposite color, depicted in a calming shade of blue somehow, and this candle nestles comfortably within the body of the preceding bearish candle, manifesting the market's indecision. It's at this moment that the narrative of the market begins to whisper of change. So the plot thickens with the arrival of the third candle, a bullish blue entity that confidently closes above the highest points of the first red candlestick. This is a significant moment in our tale, as it marks a potential shift from a bearish to a bullish outlook. So the blue candle's closure above the red one is akin to a flag of victory for the bulls in the market. As we step into the psychological interpretation of this pattern, the second candle's doubt reflects the hesitation in the market, but it's the third candle that brings a decisive moment, is closing above the first candle, signifying the buyer's growing dominance and the possibility of an ascending market. So in conclusion, the three inside up is not just a pattern, it's a narrative of a market in transition. Traders observing this pattern should seek further confirmation, ensuring that this isn't just a fleeting moment of hope, but the start of a new bullish chapter. So in that case, you are going to hire another momentum indicators, or let's say using something like RSI to get a solid confirmation from the market that is going to be a signal of transition from sellers to buyers in the market. Okay, now let's take a look at two important bearish reversal patterns. In this slide, we'll be separating the evening star candlestick pattern, a vital indicator in the realm of forex trading. This pattern emerges at the pinnacle of an uptrend, serving as an indication of the potential shift from bullish to bearish momentum. And let us begin our journey with the first candle, again, of this pattern, a long bullish one you see vividly colored in blue. And this candle is a clear representation of a strong bullish push where buyers are firmly in control, driving the prices higher. Transitioning to the second candle is a small body, see, which can be either bullish or bearish, doesn't matter. It's displayed in a neutral or gray shade, that would be better. So this candle gaps up from the first one. This is the first indication that we can get to identify this pattern, encapsulating the sense of market indecision. At this juncture, the initial bullish fervor wanes, giving way to uncertainty and hesitation among traders. Okay, so the narrative reaches a critical point with the third candle. A long bearish candle is steeped in red, and this candle completes the pattern by closing below the midpoint of the first candle in the pattern. It's a decisive moment that marks the bear's resurgence, undermining the previously dominant bullish trend. So this evening star pattern is a potent tool, but it demands prudent confirmation. Don't forget it, please. Relying solely on this pattern for bearish entry can be risky, hence corroborating it with other technical indicators enhances its reliability. And it's a pattern that becomes traders to pause and reassess, highlighting the potential for a significant shift in the market's direction. So as stated here, again, it's better to wait for an additional confirmation. And the first confirmation is closing the third candle below the midpoint of the first one in the pattern. And then we need a tool like RSI or MACD, or to, let's say, confirm the reversal in this pattern. And then to trade this, we can set our stop loss order typically above the highest point of the star candle to manage our risk. And as we mentioned, we can go as far as 1-to-1 risk to reward ratio by measuring the distance between our entry point and our stop loss. But don't worry, guys, about this. We will discuss it in more nuanced, detailed uh, sense later in this webinar. So there is another important bearish pattern called 3 inside down candlestick pattern. It's a reliable formation that signals a shift from bullish to bearish momentum. The 3 inside down pattern is composed of 3 distinct candles, as you see here, which together paint a picture of changing market sentiment from bullish to bearish. So the formation begins with the first candle. This is a large blue, or traditionally, I say blue candlestick, representing a strong bullish momentum or movement in the market, and its size and color denotes the dominance of buyers in the market during this period. And then we see the second candle introduces uncertainty here in the pattern. This is a small red, or uh, traditionally black descending candlestick, and crucially this candle is contained within the range of the first candle's body. This is the point. This is the first step to recognize this pattern, and this suggests that the bullish momentum is being questioned by sellers, and traders should be alert for a potential reversal. And then we have a confirmation with the third candle. The pattern is confirmed by a third red candle that closes below the lowest points of the first candlestick, as you see here. This indicates that the bears have taken control and that the prior uptrend may be reversing. So psychologically, as stated here, the pattern narrates a story of market dynamics. Let's say the strong initial bullishness is met with skepticism of the second day, as evidenced by the small bearish candle. And the closing of the third candle below the first candle's low confirms that the sentiment has indeed shifted, with sellers overpowering the buyers. And when this pattern occurs, it signals traders to consider preparing for a bearish move in the market. It's often used as an indication to exit long positions as well, or to initiate a short position and enter the market uh, for selling or short, let's say, positions. Ideally, if it's a confirmation of additional indicators or market factors, as we discussed, the RSI can fit this pattern very well, or it would be more, let's say, reliable pattern if you see uh, the market is bouncing off any potential resistance level at the top of the highest level of the pattern. So traders should watch for this pattern as part of their technical analysis toolkit to make informed decision in the forex market. And this is what you usually see a lot in the market, because as especially in forex trading, as we have a continuously uh, formation of candlesticks, so means that it's really hard to identify the exact perfect shape or formation of each bearish or bullish pattern, like engulfing, like Harami. But finding 3 inside down candlestick pattern is something that can save a day for us in trading. So let's transition now to some golden rules of thumb for using candlestick patterns distilled from the wisdom of seasoned traders. Part of them are those that I found during my trading experience. And these principles are vital in transforming patterns from mere chart formations to powerful tools in your trading arsenal. First and foremost, context is key. Every candlestick pattern must be analyzed within the broader market context. This includes understanding the prevailing trend and key support and resistance levels. A pattern's significance is amplified or diminished based on where it appears in the market's narrative. So please remember that candlestick patterns are not standalone signals. They are part of a larger story. Okay, very well. So next we have confirmation. Confirmation is crucial. One common pitfall is acting on a pattern too hastily. Always wait for additional confirmation, which can come from the subsequent candles or other technical indicators. This approach reduces the risk of false signals and increases the likelihood of successful trades. In forex trading, where volume data isn't available, like in the stock market, focus on price action and relative movement. Assess the strength and validity of a candlestick pattern based on the preceding and following price action. This can provide insights similar to volume analysis in other markets like the stock market. And lastly, never underestimate the importance of risk management. No matter how convincing a candlestick pattern might appear, always set a stop loss order to safeguard your capital, because as long as candles represent the market sentiment, we know that the real players are real humans in the market, so the sentiment can shift as fast as it emerged. So it's really important to ensure your position size aligns with your overall trading plan and risk tolerance. So this disciplined approach is what separates successful traders from the rest. In summary, these rules of thumbs, context, confirmation, price action analysis, and risk management are the cornerstones of effective trading with candlestick patterns. And so they encapsulate the essence of not just reading the charts, but interpreting them wisely and acting prudently. Let me just open up my MetaTrader platform to maybe show you how we can apply these rules on a real chart. I hope you guys can see my MetaTrader 4. I appreciate if you can give me a confirmation about that through the chat box you have, so we can proceed further. Very well, thank you. Okay, so it seems that it's fine. Okay, guys, as you see here, I have gold on my chart, and if I zoom in a bit, so it will be more easy for all of us to see. For example, here you see we are in a downtrend for sure in gold market since the Asian session today. Okay, after breaking below this low here. Okay, so the first thing that you can see, as we discussed, for example, look at the context. This is the key. So we need to analyze the patterns within the broader market context. For example, first of all, we need to look at the price action to see the, let's say, market tops and market bottoms, and to understand the market sentiment through the candlesticks. Then we need to identify a reversal patterns, bullish or bearish reversal patterns. The first thing that we can use is RSI as an indicator. You see, anytime that usually RSI goes to the overbought or oversold area on gold 5-minute chart, we usually can see or identify a reversal pattern during candlesticks. So it means the market sentiment gonna shift, but it's gonna shift very smoothly sometimes, or very sharp the other times. So it's really crucial to understand the nuance of the candlestick patterns. For example, here as we see, the failure swing pattern is forming in over both RSI region. So we see this Harami pattern emerge into the market, but as we stated in our previous webinar, we need to see a close of the third candle below the low of the pattern. So the problem is that the third candle doesn't approve this reversal. So in real market, the context is a key, because we see we are in an uptrend somehow, like here, because we are above the moving average, both moving averages, the long moving average, the 100 period WMA, and also the short one, which is 50. So also we have RSI in overbought territory, which means we are at the somehow the highest point of our uptrend. So a reversal is probable. The best way to enter this trade is when we see a close below the low of the first candle in the pattern, this Harami somehow. Let's see if it is a Harami or it is a dark cloud pattern. We were here, you see, we have the open of the second candle lower than the close of the previous one, and also it didn't engulf the preceding candle, so it means we have the Harami. So for trading this Harami, we need to see a close below this low, and at this moment the market appears to be more bearish, so it can be an entry point for us, but it could be also very tricky. But this is the context that we can understand. We are at the top of our prior upward movement in an uptrend. We are above the moving averages, and we are in overbought territory. So this is the way. And also we get this confirmation from the RSI as we discussed. And also we'll look at the price action. We see the body of the previous candles are so, let's say, small, which determine the, let's say, the lack of momentum, lack of bullish momentum into markets. So we can, and also we see the following candles can't get to the high of the previous candle in this pattern. So this is another indication of bearish momentum is prevailing. And also we need for sure to manage our risk, which means if you are going to trade this pattern, you need to set your stop loss somehow above the top of the pattern, and you need to measure the pip at risk you have like this, and it's going to be your entry point somehow here. So it's better to just stay with your risk management rules and have your profits, your take profit level at this level, at the 1-to-1 risk to reward ratio. This is the first thing. And because the market sentiment in a very short term time frames can just turn around quickly, so you're gonna end up in loss. So this is the you see, this is the condition that the all rules that we need are matched, and they confirm each other. The market context, the confirmation from the indicator like RSI, and the price action, and also we can enter the market with a solid risk management rules. Okay, cool. So let's continue with the trading strategy for bullish candlestick reversal patterns. In this strategy slide, we are outlining a practical approach to trading bullish candlestick reversal patterns. You might see in many different books, there are many different strategies, but that's when I started trading, I found it really confusing for myself, because remembering the shapes, the name of the different candlestick patterns, which are more than 50 and more than 176 that Mr. Nissen has in his book. So it can be really confusing for a newbie trader, and it was for me that time. So I try to gather all of them and somehow combine them to define a general rules to develop any type of strategy for trading these patterns. So these rules are designed to help you capture potential upward movements effectively. Doesn't matter what kind of candlestick pattern you identify, doesn't matter if you know the name or not, but you will be able to trade it in the market. So let's begin with the identification of bullish reversal patterns. Key patterns to watch for are the hammer, bullish, engulfing, morning star. These three, you see them a lot, and also the three candles up. It's crucial to observe these patterns in the downtrend or near key support levels, as this context enhances their reliability. So first of all, you need to find these bullish candlestick reversal patterns when you are in a downtrend. So you are going to trade somehow, sometimes against the prior trend, or somehow you want to get the most in line with the prior trend. Okay, so but the strategy here suggests to observe these patterns in a downtrend or near a key support levels in an uptrend, as this context enhances their reliability. Once you have identified the potential bullish reversal pattern, the next step is determining the entry point. Patience is key here, because you see the market and the candle, the close of the current candle is moving as the price moves. So wait for the pattern to be confirmed by the next candle. A confirmation is indicated when the following candle closes above the high of the reversal pattern. This is your cue to enter the trade. Now let's talk about the exit point. After finding a good entry point, after you see the market, the next candle closes above the reversal pattern's high. This is really crucial, guys. You got some confirmation from your favorite, let's say, indicator or oscillator, and you have a solid pivot point, like a solid, let's say, support level somehow, then you can find your entry point. But it's really crucial as well to find to spot your exit point very well. So let's talk about the exit point. You can set a target profit based on upcoming resistance levels or a price objective that aligns with your trading plan. Another approach is to monitor the price action for signs of weakening momentum or a potential trend reversal, which might be your signal to exit the trade. What does it mean? It means Or for example, let's say if we want to find a beautiful reversal here, for example, you see we have a downward movement here. The price just fell below the moving averages, both of them. And then we see somehow, and somehow like what we discussed earlier, this is a reversal like engulfing pattern in the market, and which ended up with this doji here. And then we see just matching low in the market. So if I go to higher time frame, let me just point it out here, and then you will see how it's just like tweezers that we discussed earlier. Or let's say in our 30-minute chart, you see, oh, excuse me for that, I lost it. Sorry guys, let me just find it again. Yeah, by the way, let's find another one. For example, during a reversal, we were looking for a reversal pattern. Yeah, let's say something like this. For example, guys, you see here, we have a long uptrend in a 5-minute chart, okay? And then after this correction to the downside, the price fell below the moving averages, but you can see because of the uh, horizontal slope of these moving averages, and also based on the price action, we see we are in a continuation pattern here. So if we find any reversal, bullish reversal candlestick pattern, that could be a good signal to enter the market somehow. And you see here we have an engulfing pattern. And then the third candle started above the high of the pattern. And also this is a hammer. This is another, let's say, bullish signal for us, engulfed with this almost long body candle afterward. And we are just in between the moving averages that signals a range market. Okay, in that case, we can just target the upper sides of this range pattern, and then that would be an entry point for us. But we for sure we need to put our stop loss somewhere here to keep it as our stop loss. And we have to understand that we are trading this range, so we should be very careful with our risk management tools, with risk management rules, because we need to close as soon as we touch the point here, and we may not wait for the market. Or this can be, let's say, and the confirmation here, this can be trading pattern for us. The confirmation here is finding RSI crossing above the 50 level, which is a clear signal of changing the market sentiment, and it means bulls are getting back in control. So we can confirm this reversal pattern using the RSI crossing above the 50 level. So you see, this is a complete trading setup. We have the stop loss here, we have our entry point, and we have our exit point. And then you need to assess this setup to see if it fits you, because you may go only about the 5 pips higher. You can expect that. This is a very, very sweet, let's say, trading strategy for scalpers. So in summary, this trading strategy revolves around 3 key aspects: identifying the right pattern in the correct context, entering the trade upon pattern confirmation, and managing your trade with a clear exit strategy and a prudent stop loss. Remember, successful trading is much about managing risk as it is about identifying opportunities. We have this strategy for trading bearish candlestick reversals as well. Developing a strategy for bearish candlestick reversal patterns is crucial for forex traders. We can trade both sides of the markets. Firstly, it's important, again, to accurately identify bearish reversal patterns. Key patterns include the shooting star, bearish engulfing, and evening star or 3 candles down. These patterns are most significant when they appear during an uptrend or during a downtrend near resistance levels, as they signal a potential shift in market momentum. For example, if you look at any downward movements in the markets, you know, the rule of thumb is that we expect moving averages to act as resistance and supports levels during the downtrend and uptrend. So, for example, here you see we have a downtrend in the market. You don't need to go just with the trend. You can just identify this 50 WMA as a potential resistance level, dynamic resistance level during this downtrend, and then as soon as you see this shooting star here, or let's say inverted hammer, or any, you can name it, doesn't matter. You see this long shadow here, 2-3 times the body, followed by this descending candlestick here, and then you see the third one just dropped below the low of this shooting star here. So it can be actually a trading opportunity, but you must go very, very low with this, as it can be a really tricky one. Okay, for trading, because guys, please remember the fact that it's not just it's not a chart pattern. Okay, we are not going to trade the chart pattern during this strategy. This is just the candlestick pattern. So this reversal pattern can change, can turn very, very quickly, as quick as it emerged. So it's really important to have a solid risk management rules. Okay, or if we go to another instrument like your USD, for example, 15-minute chart, you can find many different ways. For example, that was one we want to trade in line, or let's say in the direction of a prior trend, or sometimes we want to trade reversal against the prior trend. You see, we have an uptrend here, and then here we have another engulfing there, and then this is an opportunity to trade this setup here. And if you look just right now, you see the market is in range, and this is the Harami pattern is emerging. The one big mistake is that you jump on a trade based on the last or this current candlestick here, because we see the market is moving right now, and this is a 15 minutes, and we have still some time remaining to close these candlesticks, and we can't predict that this candlestick might close below the low of the previous candle, or can just form the Harami like this, or it might reverse just all the way up, back to the up maybe. So it's really crucial to wait to get a clear confirmation from the pattern seeds, and many traders make this mistake. So this is just the same. We need to spot your bearish reversal pattern. We need to find our entry point, as discussed. It's going to be a candle closes below the low of the reversal pattern. It's very important. And the third candlestick can be a confirmation for us, or we can rely on the other indicators or oscillators tools. And then we need to plan our exit point as well, based on the context that we are trading in that, because if it's too risky, I suggest taking a less profit and exit the market. Is better to get the stress, all around the market fluctuations. So you need, as well as your exit point, you need a stop loss, proper protective stop loss, which usually comes above the highest point of the reversal pattern. Okay, here are some examples to demonstrate what we discussed today. Trading bullish candlestick reversal patterns involves several key steps, as we discussed, from identifying the pattern to setting up the trade with appropriate risk management. And you see, potential first, we need to look for pattern at key levels. A potential reversal pattern like hammer, bullish, engulfing, morning star at support levels, or Fibonacci retracement levels, or following a downtrend. Then we need confirmation. For example, here we have a bullish Harami pattern, and we have a confirmation from the RSI crossing above the 50, and we are in a downtrend, and we see we have a last market bottom somehow higher than the previous one. It is a very, very reliable signal of it changing the sentiment in the market. And then we see at this the fourth candle, we close above the high of the pattern here, so it can be our entry point. And then we need to manage it based on the next reversal, or just based on the risk to reward ratios. So enter a long position when the price breaks above the high of the pattern. It's a rule, guys. For instance, after a bullish Harami pattern here, the entry could be set above the high of the first candle. And then some traders, I see, prefer to wait for a pullback or a retest of the support level to enter, seeking better risk reward ratios. And the next step is placing a proper stop loss order just below. Put your stop loss just below the low of the reversal pattern to minimize potential losses if the reversal fails. And another method that I've seen is to use the average true range indicator to set a stop loss that accounts for market volatility, typically 1.5 or 2 times the ATR below the entry point. That's another one that we may discuss it when we teach the momentum oscillators. And then setting take profit level, it can be the next resistance level or swing high as a potential take profit level, or you can choose a good risk reward ratio based on the pattern that you are trading, or based on the market condition. If it's just before a news announcement, you need to exit the trade as soon as possible, or if it's getting to the end of the session and you may face a swap charge, so you need to exit the market again. So set a take profit level that respects a predetermined risk reward ratio, commonly 1 to 1 or 2 to 1. For example, if your stop loss is set as the 5 pips below the entry, 2 to 1 risk reward ratio, set the take profit level at 25 at 2.5 pips above the entry. So this is another way. And as the trade moves in your favor, consider moving the stop loss to break even or using a trailing stop to lock in profits, if only if you can see that your reversal pattern is in line with a reversal chart pattern. For example, you see we have here something like a double bottom that we will discuss in our next webinar. And then this candlestick pattern here can give us a very great entry point, so we can go maybe higher with this price movement after breaking above the high of the pattern. So this is the way it, again, is all about the context that you are trading in. We have also trading a bearish candlestick reversal patterns, involves a strategic approach that incorporates pattern identification, confirmation, and careful planning of entry, stop loss, and take profit levels. So as you see, first we need to identify or recognize a bearish pattern. Here we have a dark cloud pattern. We have a very small gap above the previous close, and then we see this candlestick just closed below the midpoint of the previous one. So it means this is a dark cloud pattern. And then we have a close below the first one, and even though the price just got away back in the fourth candle, but as we have a proper stop loss here, we can still stay in the trade. So afterward, we see we can reach our maybe take profit level. So first, we need to enter a short position when the price breaks below the low of the reversal patterns. We need to wait until we see a completion of the pattern. For example, after a bearish engulfing pattern or this dark cloud here, you could enter just below the low of the first candlestick. But some traders might wait for a pullback to the pattern resistance area, and in longer time frames you can find it a lot. And then you need to set your stop loss level. A stop loss can be placed just above the high of the reversal pattern, as you see here, minimizing the potential loss if the reversal doesn't materialize. So also you can choose a volatility-based stop loss. Utilize the average true range to set a volatility adjusted stop loss, commonly placed 1.5 or 2 times the ATR above the entry point. And it's going to be a way to trade this setup. And again, risk reward, determine your take profit based on the set risk reward ratio that you are comfortable with. Here, based on the context, we are at the beginning of a downtrend, so you can go a bit maybe lower with the price. So you can set your stop loss at the 1-to-1 risk to reward ratio, or you can also set a partial profit taking. You may choose to take partial profits at predetermined levels while letting the remaining position run to potentially capture more downside movements. And monitor market news and be prepared to adjust your strategy in response to new information or market conditions Trading bearish reversal patterns require a disciplined approach, guys, to risk management and an understanding of market structure. So no pattern works all the time, okay? So prepare yourself for some losses for sure. So it's crucial to prepare for both winning and losing trades. Make sure to test these strategies on a demo account before applying them to live trading. Okay, that's it for today. I would uh, be very happy if you have any question that I can answer very well. Okay, great. No question. Yes, girl, let me just thank you all again for participating in this webinar. I hope you found the content a bit helpful in your trading journey. I'm always open to any question you might have. Thank you so much, and uh, hope you have a great evening. Thank you. Bye bye.